presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management Market Update for September the 20th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. We're going to talk about what to expect this week, what to expect next week. Well, tomorrow, the biggest thing that we're looking at is the Fed meeting. They're expected to raise interest rates. A lot of nervousness in this market. But every time the Fed has raised rates this year, the market has gone up. Right now, the fear is palpable in the markets. Everybody's saying, well, 80% probability that the Fed is going to raise by 0.75%. But there is the other 20%. What is that? I'll talk about that. We'll take a look at the U.S. economy, the international economy. It's not just U.S., but just about everybody else is slowing down. So we'll take a look at that. We'll take a look at the technical analysis and the market meter and a look ahead at the week. So let's start with the Fed. The Fed is expected to raise rates. The yield on the 10-year today at 3.60 as a high. That was the highest that we've seen in about 11 and a half years. The 2-year is pushing close to 4% now. That's the highest rate since 2007. So we've seen the rates already, and the market has already raised rates. What we do not need as far as the market is concerned, some more surprises from the Fed. Are they going to do 75 basis points, 0.75%, or are they going to do a 1% increase? Well, the expectation is the Fed is going to raise rates. This is now the expectation that the Fed could go to 4.5% by first quarter of next year. A week ago, the expectation was that the Fed was going to end somewhere around 4% as a peak, a terminal rate as it is expected. What does that mean? That means the Fed could do 75 basis points tomorrow, do another 75 at the next meeting, another 50 after that. Previous expectation right here was that the Fed was going to do 0.75 tomorrow, 0.50 at the next meeting, and 0.25. And that would bring us back up to about 4%. That's the number we're looking at. But here we're looking at 0.75 tomorrow, 0.75 at the next meeting after that, and then 0.50. That increases by another 50 basis points, so it puts us at closer to 4.5% instead of the 4. I don't think the market is prepared for 4.5 for the 10-year. I think we're looking at about 4%. That is where the peak was. So if you have to adjust, when rates go up, that pushes the market lower because the future you have to discount the growth on companies by the interest rates. And I think at some point we're going to raise rates to a point where people say, well, I don't need to take the risk in the stock market. I can buy a bond and get 4.5 or 5%. I'm happy with that. And that's when the bond market starts to go back up and the stock market starts to stabilize. But until we get there, we're still in this state of how high is it going to go and how quickly are we going to get there. No one knows, and I don't think the Fed knows at this point how much they're going to use. But the expectation is, again, that the future inflation is still there. That's the tips. Looking at the U.S. economy, CPI came out a couple of weeks ago at 8.3. Core is what, even though this turned down from 9.1 where it was in July or in June. July we hit 8.5, now we're at 8.3. But the surprise was this, where this went back up. This is the core rate, which excludes food and energy. It's still going up. So that's what the Fed looks at. Basically, PCE is what they look at, which is a core rate. And they want that down to about 2%. I think we can get to 3 or 4 by sometime next year, depending on how slow the economy gets. If the economy does not slow down, the Fed will continue to raise rates. Inflation, again, that's what we're looking at, the prices that are sticky, ex-food. You can see that this is ex-food and energy prices are turning up, and that's not a good sign. And we've got to see those turning back down. Goods and services, commodities, ex-food and energy, those have come down. But the problem is, again, service inflation keeps going up. And that is where we're seeing services now are catching up with a lot of the other stuff as the economy reopens, as people start traveling. Hotel prices are way up, airlines tickets are way up. You're looking at just, and one the thing that occurs the most is shelter prices. You can see shelter. This is the home national price. You can see that has turned down. That's real estate prices, but you can see rents, which is shelter, is still going up, and that is a big contributor to inflation. And even when prices start to come down, the shelter price does not show up for about 12 to 18 months. So once people raise rents, they're not coming down next month. They don't raise, once the landlords raise rent, they don't bring them down to the next month. So we could see shelter inflation continuing to contribute to higher inflation prices. Looking at the economy, so the economy here in the US now is going to slow. The Fed has said that they do not care about a recession. The Fed has said that they are going to continue to raise rates. How much can they tolerate? I think they've got a dual mandate: keep inflation low and keep unemployment low. Unemployment is close to a 50-year low, so they can raise rates. Until unemployment goes up, they can continue to raise rates, because that's what everybody cares about. And that when they raise rates, that slows down the economy. And that's a delicate balancing act. Fed is never quite getting it right. Last year they were saying no inflation. They were way behind. Now they're saying way too much inflation. So are they going to do too much is the question. When do they take their foot off the brake, or take the pressure off the brake and start increasing interest rates at a slower pace? We don't know that yet. Looking at the global economy, the Chinese unemployment rate has come down, but they still have these scattered zero COVID policy, where they shut down cities as soon as they're, some cases shut down Chengdu, which is a city of 21 million people. They shut it down. They are starting to reopen it, but that is still a problem in China. Retail sales are not bad. Survey was expecting 3.3 or 3.8, 5.4. They were looking at 3.3. So look at the UK unemployment. You can see that is going straight up. European economies are in trouble. They're going to have a tough winter as as they'll need more energy. And even though their stocks are up, they're up to about 90% of what they need. The storage is just about full of energy. But if it is a cold winter, then the drawdowns and the demand for that energy will be severe, and the prices could go up. European storage, as I mentioned, the gas storage is way ahead of where it was in 2021, and this is the average. So they've stored up more gas than they have in the last 10 years on average. So they have storage now. Russia has totally cut off the Nord Stream 1 pipeline, and it's going to be a tough winter for the Europeans, but we'll have to wait and see. Canadian economy, this is the forecast. It is going to continue to go down into the fourth quarter, then expected to turn back up. We'll see. So the global economies are slowing down. As the global economies slow, and we saw a report from FedEx saying the same thing, that could mean that U.S. economy is going to slow. How much it's going to slow will depend on how much the Fed raises rates and how quickly inflation comes down. We don't know if it's going to be a mild recession or a severe recession. The chances of recession have gone up dramatically over the last couple of weeks. So now we'll have to wait and see. And how does that recession, how much does it slow down the economy? How much do companies are unable to sell their products when the economy slows down and they make less money? That's going to be the case that we'll have to watch. Don't forget to join me on the daily broadcast. You can go to the App Store, the Apple App Store, and type in all this one word, Market Wrap with Mo Ansari, and the app will pop up. It's free of charge, and you'll get the daily edition of Market Wrap. Great guests every day and 1 hour market update every day that you can get. Looking at the technicals of the market, interest rates, this was the previous target at 3.48. Well, we've exceeded that, and today we hit 3.57 was the close. This is the highest close, as I mentioned, 11 and a half years for the 10-year interest rate. The higher the interest rates go, the lower the bond market goes. That's how they're priced. They're priced inversely. As long as the interest rates are going up, the stock market is going to suffer. And that's what we saw. The market was down. Next support is this tiny gap. This does not overlap right here, and that's right around 3,800. That's what I'm looking at next support. If we break 3,800, we get below that, then we would be looking at this, which is about 37 and 38, 37, 38 or so. We break that, then we're looking at this low, which has been the low of the market at 36, 36. Looks like we're headed towards that unless we turn around tomorrow and we hold 3,800, then all of this was just an ABC correction. And that's what I was looking at when we hit this high in August. I said September is going to be tough. Here we are in September, come down, shaking out all the nervous people out of the markets again. And usually the fourth quarter is good. But have we made a bottom in September yet? Or are we going to get to October before we make a bottom and start turning up? We could get another couple of weeks of volatility. And after that, I think we're going to see the market turn around and start heading higher. That's the way seasonality works. Technically, again, resistance around 41.79 and 42.98. Same thing in the NASDAQ, tiny gap here in the middle of July, so that's 11,250. If we get there, I think I'll start worrying about really the market heading to 10,000. That's this low, the June low, and maybe even making lower lows than that. So that's, again, looking at the weeklies, this is my dot plot. The Fed puts, and as long as this is the market, as long as the market is above the dots, it's in a positive mode. Here we hit the dots, went above the market, and the market was below. That means a bearish market, and that turned out down at the beginning of this year, stayed down until the middle of August. Beginning of August right here, that's when the dots got below the market. That's a positive indicator. But we went up and turned right back down again, which is very unusual. We've only been up for 5-6 weeks. If we break below 11,250, that would be a bearish sign. And usually when the market turns down, as it did, it stayed down for about 8 months. Here it turned up, stayed up for about a year and a half. This is a weekly chart where each one of these lines is 1 week of trading. That would be, if it breaks below 11,250 and really 11,000, then probably we could be headed to somewhere around 9,200 for the S&P, for the NASDAQ on the downside. Crude oil, 81.20 was the low that we made last week. Bounced back up, 20-day moving average right here. Could not quite break it. Here we are today, down to about 84.45. I think 96.5 is resistance, 81.5 is support. 80 to 100. I was looking between 90 and 110. Now we're looking at between 80 and maybe 100 in oil prices, depending on how slow the global economies get and if nothing untowards happens in the Ukraine-Russia war. That is now becoming more and more unpredictable. Gold prices broke below the 1678 low, 1675 low that we had made, and now we're starting to head lower. Broke it last week, bounced up. Target now is around 1600 for the gold market. We're about 1673 today is where we close. So overall, markets are on the back foot right now, expecting the Fed to raise rates tomorrow and seeing what the Fed does, what the Fed says. The Fed says we're going to continue to do this until we have clear signs inflation is coming down. We're going to continue to raise rates. That'll continue to put the pressure on the market. If the rates start to come down, interest rates are stabilized, then we could see a rally like we did right here. Rates, if you go all the way back and look at the rates right here, they made a high in the middle of August or middle of June, and that's when the market made a low. The rates dropped from there and the market took off. But the rates bottomed at the beginning of August, and rates started to go back up. The market started to come back down. The rates peak right here again, start coming back down again. That could be bullish, but we'll have to wait and see what the Fed says tomorrow, and that's going to be something. Again, you have to have the right allocations. You have to have the right mix of assets, bonds and stocks. I know markets are down. Market is down about 20%, the S&P. If you're down 10 or 12, you're okay. That's part of life. We have had 5 great years in the market. This year, it's a little bit choppier. But if you're down 40, 50, 60%, you have a problem. Give us a call. We'll be more than happy to help you out. All you have to do is dial #250 on the cell phone and say talk to Mo, or just go to the website at compak.com. Again, the probability of a recession have gone up now to about 55%. That's the way I would term it by the end of this year. And again, don't forget, I'm going to do a webinar on November the 2nd, or I think it's a live webinar on November the 2nd. If you want to go and register for that, go to compak.com and register. It's absolutely free. Those are my views. Looking at those are my thoughts. Again, I think what the Fed does is going to dictate what the market does. Thank you again for joining me. I will be back with you next week. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.